Hello and welcome to our latest Insider interview. I'm Caldwell and today I have with me Brian Kersmanc, Fund Manager of the GQG Partners Global Equity Fund. Brian, thanks for coming in today.
No, thank you very much for having me.
So Brian, GQG stands for Global Quality Growth. Now in the past, the Global Fund has had exposure to certain sectors that neither fit the quality or growth descriptions. For example, in 2022, you had exposure to energy stocks. So what does global quality growth mean to you?
Yeah, so as a firm, one of the things that we kind of pride ourselves on is this sort of open-mindedness of where growth can come from and where quality can come from. And the example I always like to use, going back to the energy sort of reference that you made, is that if I were to ask a room full of people 2 years ago, is Exxon, for example, a high quality company? Maybe one person out of 30 would raise their hand. I would get a lot of pushback saying it's low, high capital intensity business. They're pulling a commodity out of the ground. It's the same as anybody else's commodity, subject to economic market cycles. It's a low quality business. But if I were to rewind the clock back 10 years ago, or 20 years ago, or 30 years ago, and ask a room full of people again, is Exxon a high quality business? 29 out of 30 people would shoot their hands in the air and say absolutely yes. Quality compounding business. Even if oil prices fall, they have the midstream, the refining, and sort of the pipeline and distribution business. They're very strong as well. So that offsets and allows for quality compounding. And they're more than happy to own this in sort of their blue chip portfolio, their retirement savings, and sort of this high compounding type of portfolio. So our question is, and what we're always asking is, why was it considered high quality then? Why was it not considered as high quality over the last couple of years? And is there the case to be made for some of these energy companies for it to be a much higher quality execution story on a go forward basis? So that's really what we're trying to go for. And then in terms of the growth aspect, we're just looking to grow capital over the course of time. So we're not married to a specific style box, growth, value, or anything like that. As far as I'm concerned, there's growth, there's value, and then there's just great compounding businesses. So if I can get growth through the earnings appreciation, maybe a little bit of the yield as well, in terms of the dividend coming off of that name, and I can get to sort of a reasonable rate of return, that's great growth for me. And then you kind of wrap it in with the quality definition that we talked about before. That's what we're looking for.
You focus on the fundamentals of a business, but you also take into account the wider macro backdrop. So how does that macro fit in with how you invest?
We are fundamental bottom-up investors. Anything that we invest in, we take a 5-year view and we have a fundamental bottom-up approach in terms of getting to those names. With that said, we do also consider ourselves macro aware. And the way I like to describe it is macro will never be a switch on for us, but it can be a switch off. So we'll never say, for example, India, the macro situation looks fantastic. We need to find a bunch of things that work well. That's not the way it typically works for us. We'll find things on a fundamental bottom-up basis, and that'll organically grow into the allocations that you see. However, we do use macro as a risk-off sort of situation where we'll allow the macro to override the fundamental bottom-up thesis. So if there's a risk, a geopolitical type of risk or something going on, even if the fundamental bottom-up story of that name is very strong, we'll say, what, from a macro perspective, from a risk management perspective, let's remove that name and sort of reduce that exposure in that sense, in that way.
So let's move on to the portfolio. I can see in your top 10 holdings, your two biggest positions are to the two weight loss drug winners, Novo and Eli Lilly. So is that a key theme at the moment for the fund?
Yeah, so again, it comes down to the fundamental bottom-up sort of behavior and risk-reward of these individual names. We see these two positions, these two companies, as a duopoly within what's called the GLP-1 space. They have found a drug that really does a good job in terms of diabetes management and things along those lines, much better than insulin did, much better than a lot of the other diabetes drugs that were out there. They had recently found out as well that it has a very incremental positive impact in that it also helps control weight and help with weight loss as well. I would say that the core of the thesis for us isn't necessarily even on the weight loss side of things. And that might even be a little bit overhyped in the near term. Long term could be an absolutely massive market. I think what's really interesting is you look at just the diabetes population. It's simply a better mousetrap to address those issues. It's very hard to manufacture. They're the duopoly in this space. It's very hard for other folks to come in and disrupt that. And I think the headroom for the diabetes space in particular is very hard to disrupt, and these guys will take sort of the long-term sort of headroom in that space. The weight loss aspect is just called a call option to the upside if they're able to really execute on that as well.
I can also see in the top 10 holdings you have some exposure to US technology companies. Is this a play on artificial intelligence or AI, or is there more to it than that?
Yeah, so what's interesting about here, and one of the things to know about us as well, is that we will be very dynamic, and we will move the portfolio based on the opportunity sets that we see or don't see. So oftentimes it's as much about what we don't own at a particular time and when we choose not to own something versus when we choose to. Actually in 2022, that same year that we had a decent amount of energy exposure, we actually had basically zero tech within the portfolios as well. And in 2023, we had noticed that after a multi-year down cycle in tech, especially on the semiconductor side and semi-cap equipment, but also in other areas of tech, that after that multi-year down cycle, things seem to be bottoming out. We started seeing a lot of indications that there is sort of these green shoots, and you started seeing some re-acceleration. Valuations were also a lot more attractive at that point in time. And note, nothing that I've said up until this point has anything to do with artificial intelligence. It's just a capital cycle, more reasonable valuations, green shoots, fundamentals getting better, reasonable price on top of that. AI has almost been like the gasoline that's been thrown on the fire and accelerated this capital cycle that we're currently seeing right now, maybe even elongating the capital cycle that we've seen right now. Yet to be seen how far this proliferates, but we've seen at least in certain spaces that companies are getting a real return on AI. So we are seeing that as a sort of an interesting trend in terms of the companies that we're seeing, and we're consolidating around the names that we think will ultimately benefit the most and be sort of the epicenter of the economics of this AI investment, if you will.
Technology, it is a major theme within the portfolio, but you have been reducing exposure of late. Over the past couple of months, you've halved exposure to around 21% at the moment. Why have you been doing that, and how have you been doing that?
Yeah, so in terms of the reduction of the exposure, the way that I like to characterize it is if you think about driving down a road. We saw that the road was fairly clear. There was, bright and sunny outside, and we thought that, the risk-reward opportunity was really interesting, and we could, drive a little bit faster on the road. Conditions were pretty, safe at that point in time. I would say within the last couple of months, there may have been a couple of clouds that have come on the horizon. Not to the extent that we're overly concerned that we need to completely get out of the way of tech, but we should maybe throttle back a little bit. Maybe the road is going to be a little bit bumpier on the sort of the down the road a couple of kilometers, or maybe there is going to be some inclement weather. Let's just temper it back and neutralize the positioning, and then also sort of consolidate around the things that we think are working a little bit better within the tech ecosystem. So up until this point, software has been a little bit disappointing. So the bigger software names are areas that we have sort of trimmed back and reduced exposure on because they participate in some of the AI hype, and they did come off of sort of a rebound of that bottoming action that I was talking about, but it hasn't necessarily lived up to sort of the potential and the growth that investors expected out of them. Versus you are seeing more of the consolidation of the returns happening in certain semiconductors and certain semiconductor cap equipment within the tech space. So we have been consolidating around those types of plays a little more so than some of those other areas. So we've just rationalized that exposure down and again balanced and neutralized sort of our positioning within the portfolio.
And what's your current stance on Nvidia? I know it's in the top 10. Are you running your winner, or you've been taking some profits along the way?
Yeah, so Nvidia is an interesting one because Nvidia is, again, at the epicenter of what's going on here from an AI standpoint and from an investment standpoint. We do think that is still fairly attractively priced for the type of outlook you have, but it's not without risk either. There is always the risk that there is some sort of pull forward in demand. If that AI promise doesn't filter out into other areas, there's always that risk that's there. It is a very large company. It's a very large revenue base that they have to continue to grow, and you just do the simple math. Whether they continue to grow at 30% year over year, they're going to be the size of an EU country or UK in terms of GDP if you extrapolate that out long enough. So that'll inherently limit some of the headroom on it. But we're still quite positive on the name overall. I think that there are other names that have gotten a little bit more sort of wrapped up in the hype around AI, but Nvidia, quite frankly, keeps delivering, and the earnings continue to come through through and support the price action. So we're still very constructive on that. We may have throttled back a little bit versus the very aggressive positioning that we had previously, but still, quite excited about the prospects of what's to come. I think the interesting, the other benefit of holding a name like Nvidia is that Nvidia trades somewhere in the neighborhood of $30 billion a day in terms of their liquidity and the volume that they put through. So even at size for us and the size and scale that we operate, if we need to reduce sizing in Nvidia and have a slightly smaller call, if we want to ramp back up, let's say the data continues to push in the right direction and we're a little bit too nervous about sort of our positioning, we want to go back aggressively the way we were before. At trading at those volumes, it's very easy for us to size up and down a position like that without having any impact on the market in terms of the price action or anything like that. So we believe that that's a strategic advantage that we have versus a lot of other managers might shy away from turnover, might shy away from sort of changing their sizing on names and be stuck to sort of a certain 5-year call. We'll be very nimble and adaptive and use that to our almost advantage, if you will.
And where have you been reinvesting the cash from reducing that technology weighting?
Yeah, as I mentioned before, so what we were doing is neutralizing the call a little bit on tech. It isn't sort of mandating it we're that heavily weighted within some of these names on the tech side, so we've rationalized things down. Some other areas that we found are interesting are kind of the older, more boring areas of sort of the market, consumer staples, utilities. We actually think there's some level of excitement. Maybe that's just because I'm a stock picker and I get excited about these kind of things, but well, the utilities in particular. And this is an interesting one that we have the same analysts that look on the emerging market space, that look at the developed market space, and everywhere in between. And I sort of run portfolios along with Rajiv Jain and with Sudarshan Murthy. All three of us run all the portfolios concurrently. This is actually a trend that came a little bit more from the EM side that sort of alerted to us to what's going on the developed market side. In EM, we noted that baseload electricity supply was not enough to fulfill the demand that was coming. And that was happening in some of the higher growth countries, but even in other areas where they've pushed renewable power a little bit further, there was enough power, but there wasn't enough stable, reliable baseload power. You translate that over to the US and you're starting to see the same type of thing happen here. Data center or no data center, and especially in the states that have larger population growth or more electrification that's happening overall, you're seeing that there hasn't been enough baseload investment in terms of core baseload electricity production to fulfill that demand that's out there. So that's an interesting area that we're seeing. The multiples on a lot of those utility names had come off and sort of are trading at much more reasonable values. And we believe that the growth prospects, believe it or not, there is growth in utility, as boring as they are sometimes, is actually ticking up, and you've seen some pretty interesting results there. Staples, another area that a lot of folks had bought into last year. They pushed the multiples pretty high, mid-20s for some of these staples companies, high quality businesses that hadn't necessarily changed, but they were bidding them up because they were looking for safety. And we were expecting that a recession was going to come because the central banks around the world had raised interest rates. The recession didn't necessarily materialize. Things might have slowed a little bit, but you didn't need that safety as much. A lot of their growth was also being driven by pricing. They're pushing pricing through really aggressively as inflation was a little bit higher. Well, volumes have slowed down on a lot of those names, and the pricing has slowed down, so the top line slowed down. And the multiples have come down to the point where a lot of these are trading at mid-teens multiples at this point in time. And now some of those volumes have stabilized, and maybe even the pricing has stabilized as well and become much more interesting. So again, that, although it's not quite as exciting as sort of the super fast growth that you get out of the technology space, you're getting really good double-digit kind of compounding out of these businesses. They will protect a little bit better to the downside, hopefully. They typically do. And we think that they're a good sort of ballast and compounder within the portfolio overall.
What other trends or sectors are you favoring at the moment that you have a lot of conviction in?
So what excites us the most is what's the earnings trajectory? So you get the earnings correct, and then you sort of see, okay, is it worth paying the multiple that you're paying for that? I think what's exciting about a lot of these staples names is, yes, they have come back in, but you can get that visibility of that earnings duration on a longer term basis. And you can see that, if you're a Nestle, for example, and you're selling coffee, there's good organic growth in that category. There's good organic growth in sort of the pet food category. You're also seeing that they're trimming the portfolio of these other sort of ancillary products that haven't been as good growth. So they're focusing on the areas, sort of that 80-20 rule, if you will, the 80% of the profits being made by 20% of the portfolio. They're focusing on that smaller part of the portfolio that's really driving a lot of the growth and the value. And that could create a sort of a higher quality investment with good visibility on a longer term basis.
Brian, thanks for coming in today.
Thanks for having me. Appreciate the discussion.
That's it for our latest Insider interview. Hope you've enjoyed it. Let us know what you think. You can comment, like, and do hit that subscribe button. And hopefully, I'll see you again next time.